Hey guys, what's up? I'm Erin and welcome back to the channel. What makes a good rate of return? Is it perhaps a guaranteed rate of return? In the early 80s, you could easily find CDs with a guaranteed interest rate of just under 12%. At first glance, it's really easy to say, what an incredible rate, what I wouldn't give to lock in a guaranteed 12% rate of return. And right now, I guarantee you there is someone typing their favorite YouTube comment ever when I talk about rates of return. What about inflation? Back in the early 1980s, it is worth pointing out that the US was experiencing some pretty intense inflationary pressures. Inflation topped out around 14%. So while 12% sounds absolutely phenomenal at first, once you factor in inflation, well, it kind of bursts the bubble a little bit. That brings us to the difference between nominal rates of return and real rates of return. Nominal rates of return are those stated interest rates, like in the 80s when banks would state that you could get a 12% rate of return on CDs, or when we talk about the stock market and say that it has an average annual rate of return of 10%. All of these numbers are stated before inflation. Real rates of return are what you get after you factor in inflation. So, nominal rate of return minus inflation equals real rate of return. So in the 80s, when CDs were locked in at that 12% rate of return, and you subtract that 14% inflation rate, that leaves you with a negative 2% real rate of return. And quite honestly, it probably doesn't really sound all that appealing for the local bank to advertise, lock in your 12% rate of return here. Inflation is coming in hot at 14%. So at that rate, you're only losing money at the rate of 2%. But hey, there's a reason I don't have a career in marketing. Right now in early 2022, you can find CDs with a guaranteed rate of return of 1.15%. Again, remember, that's going to be your nominal rate of return. Inflation is currently sitting around 8%, so your real rate of return would be about a negative 6.85%. Not that you were jumping for joy at the prospect of getting a 1% rate of return, but once you factor in inflation, it's even less appealing. I can't imagine anyone getting really excited about losing purchasing power at a rate of about 7%. Now, please don't take this to mean that I am against CDs. I am not. Depending on your financial circumstances, CDs can absolutely have a great place in a portfolio. For instance, if you need money to guaranteed be there in the next handful of months or even the next couple years, CDs can truly be a valuable asset. I'm just using present figures to highlight our current circumstances of low interest rates and high inflation. If we want to use historical reference points of the stock market to demonstrate real versus nominal rates of return, we can just as easily do that. The stock market has averaged a 10% rate of return. The US on average has faced a 3% rate of inflation, which would translate into a real rate of return of 7%. Inflation is a reality, and I think based on our current situation, more people are acutely aware of that than ever before. But even when inflation is low, say 2 or 3%, it still is a reality and it still has to be factored in. That's why we have to figure out the difference between nominal and real rates of return. Real rates of return are what matter most. If the market returns 8% and inflation sits at 8%, well, it's a wash. Sure, the number reflected in your account is higher, but you don't actually have any greater purchasing power. If the market does as it's traditionally done and gives you a 10% rate of return and inflation reverts back to a 3% inflation rate, well, then you're actually growing your wealth. Your purchasing power is increasing. You're becoming wealthier at a rate of about 7%. But let's say the market returns 5% and inflation stays at 8%. Well, then the number in your bank account is getting higher, but you're not actually becoming wealthier. You're actually losing purchasing power. Growing your money in real terms is what matters most. It's what allows you to have more dollars to spend. I was recently reading a few articles on interest rates, and one put forth a theory on how the demographics of a nation, predominantly age, can influence the interest rates of a country. Now, I know what you're thinking. What a fascinating subject. Please tell us where you read these articles. No? You weren't thinking that? Well, in case you were the one person who was thinking that, I will link the articles down below. But for everyone else, let me tell you why I thought it was fascinating. The theory goes like this. You can broadly define a nation as having borrowers and savers. The borrowers want to, as their name suggests, to borrow money. And the savers, well, they're kind of all set and they don't really have a need to borrow money. Generally speaking, younger people are the borrowers, and they need to borrow money from the bank in order to buy their home. They need to borrow money in order to earn their college degree. They borrow for their car and for their family vacation to Florida. That last one was just a test, just to make sure you're still listening. Please don't borrow money to pay for a vacation. The older generations may have a fully paid off mortgage and fully funded accounts that allow them to pay for whatever they may need to live their life, whether it's a car, new furniture for the home, things like that. Older generations have saved up, so they have less of a need to borrow money. Some economists use the savers-borrow ratio to see if an economy has a savers market or a borrowers market. As the nation's population gets older, we naturally have more savers and less borrowers. Those savers beef up the amount of funds available for banks to lend out. But now we have less borrowers. So now we have a situation where the banks have more dollars and there's actually less of a demand for loans. An excess supply, a lower demand, leads to lower interest rates. On the other hand, if you have a younger nation, you will naturally have more borrowers and less savers. The demand for loans will be higher, but there will be less dollars for the banks to lend out. A higher demand with a lesser supply leads to higher interest rates. The population of the US is getting older, and if you look at our nation's historical interest rates, you see that rates are declining, which coincides with our aging population. This has been a common theme in developed nations. European nations have an older population than the US, and it's been a theme there. Canada has a slightly older population than the US, but the US isn't far behind, and they've seen the same thing happen. This has been the general trend in developed nations, so it helps to give weight to this theory. Now, of course, not everyone agrees with this theory. If you ask the Federal Reserve branch of St. Louis, they actually believe the lower interest rates are more driven by the fact that we have a smaller number of people in their working years in America. This is leading to less economic output, lesser workers, less economic output of a country. And as we have a less economic output, they believe that that is leading to lower natural interest rates. Of course, there are a vast number of factors that can influence interest rates: inflation, economic growth, demand for credit, government debt, and the Federal Reserve policies that can artificially keep these rates lower than they otherwise would be. But the real takeaway is that as our nation's population ages, it's unlikely that we're going to see any big increases in interest rates. Our current interest rates are set near zero, and a lot of factors went into that. We had a pandemic, a financial crisis, just to name a few. Will rates go up from here? Sure. The Fed's announced that they were going to increase interest rates, but it's doubtful that you'll see any big movements. We can anticipate that these stated guaranteed rates of returns on CDs and money market accounts are going to stay low, or at least on the lower end of the spectrum. But we currently have a situation of high inflation and low interest rates. These two items cannot coexist together long term. Eventually, something has to give. With our aging population, those in the baby boomer generation are either already retired or getting ready to retire. And the baby boomers actually hold the vast majority of our nation's wealth, and they're putting a strong demand on the bond market. They want fixed income securities as they approach their retirement years. They want less volatility. They want guaranteed sources of income. But interest rates in the bond market have remained low, just like other interest rates throughout the nation. Historically, when inflation has been high, interest rates have risen to follow suit. But it might just be that our nation can't afford higher interest rates right now. All of these factors help to give merit to the economists who argue that our current inflationary situation is just temporary. But what will happen? Well, only time will tell. I know a lot of people want a good guaranteed rate of return, but don't try to take on more risk than you're comfortable with just to chase a better return. You don't want to abandon a sound financial investing strategy. Stay the course. Maybe you have to save more, maybe you have to work a little bit longer, maybe you want to look at your asset allocation, look at other investment options, maybe go into real estate or other items where you're not actually invested, but you don't want to take on more risk than you're actually comfortable with, because more risk can actually be really dangerous, especially as you're approaching retirement years. If you're younger, you can actually handle more risk, but just remember, no matter what the economic circumstances that are surrounding you, please stay the course. You always want to have a sound investing strategy that you're following. The original plan for this video was actually just to be a brief, maybe 3-minute video talking about the difference between nominal and real rates of return. But once I read those articles on interest rates, I knew I wanted to sneak them into a video. Perhaps it's not the most clickable content here on YouTube, but it was a theory that I really enjoyed, so I hope you guys got something out of it. That's gonna do it for this one. I post new videos every single week. If you got anything out of this one, if you enjoy economic theory, please give it a thumbs up. If you know of anyone who might like this type of content, please consider sharing. If you're new here, please consider subscribing. And with that, have a good day. Bye.